We've been hearing a lot lately about workers having their pension benefits cut back because the companies they work for can't keep up with the escalating costs of funding them. Workers in the public sector often enjoy even more generous pension benefits than their private sector counterparts. And now many states and cities are finding it hard to live up to their retirement promises too. What's a fair solution to this problem? I'm Sarah Bartlett, and this is our topic today on USA Inc. Joining us is Orin Kramer, chairman of the New Jersey State Investment Council, which oversees $80 billion of assets on behalf of the state's 700,000 active and retired employees. Orin, thank you for being with us today.
Thank you, Sarah.
What kind of pressures are on the public pension fund in New Jersey?
I thought we had a limited amount of time. there are...
In short form.
There are, I suppose, two major pressures. One is that generally the public pension funds have more severe financial strains than are reflected in the actuarial numbers, and Jersey isn't unique in that respect. And secondly, we have been historically unique in the sense that we are the only fund, if you looked at the top 25 corporate and public funds in the country, we're the only one that's never had a nickel in any form of alternative investments, never had a nickel with an outside manager, so no private equity, no real estate, no hedge funds, etc. The process of changing something that's existed for 50 years is shockingly, it's controversial.
But in terms of the numbers, do you have a great surplus that you can fund these retirement benefits with, or what kind of financial vice are you in, if any at all?
Well, actually, one of the good things about running the oversight board on the investment side is that we're not responsible for the state's budget, so I don't have to address the question. It actually, for example, New Jersey, and it's true elsewhere, it depends how you do the math. From an actuarial perspective, we have about $12 billion less today than we ought to have. If you said, well, I don't do this actuarial stuff, let's look at the amount of assets you actually have, real world economics, and let's say the stock market goes up 8+% a year, then suddenly it rises to, I'm $30 billion plus short of where I ought to be. So it depends how you calculate it.
But if you could make a general statement about whether Jersey is short, would you say you're pretty short from where you need to be, and how hard do you have to work to climb out?
Well, let me put it this way. There are actually two levels. First of all, in terms of how short we are, the state has a budget of $28 billion. So if you assume stocks are going to go up 8% a year, which is a higher number than the one I'd use, but let's just assume that stocks will go up 8% a year, then the size of the current shortfall is slightly larger than the state budget. Of the state's $28 billion, most of the money actually goes back to schools and municipalities and Medicaid and going to pay off debt, et cetera. The state's operations itself is only $4.5 billion. So some number like 30 billion is some large multiple of the actual state budget. But I think there's a separate thing, which is those problems, if you do the real math, exist across the country. I think in terms of running the portfolio, you're supposed to, the way I perceive it, run it in what you deem to be a responsible, risk-adjusted fashion. And if you say my bogey is out here, the state is in this much difficulty, that doesn't mean actually that you turn 7% of the portfolio into short-term commodities bets. It doesn't necessarily govern what you ought to do with the portfolio. To me, those are separate issues.
But the public pension fund problem, you are pretty close to it. You think it's a national issue?
We don't know what any financial markets will do in the country in the future. And so quantifying it is always an issue, but the way I would put it is that number one, if the total corporate problem, which everyone knows about, is X, then the public pension problem is probably 2 to 3 times X. And if you said, well, let's just make up a number. Let's assume stocks are going to be up a little over 8% a year. Then how short are we today? And by short, I don't mean we're going to need this money over time. I mean, this is the amount we're supposed to have today. And if we don't have it, it means later it'll be an even bigger number. And if you assume 8+% for stocks, you're probably looking at the public pension funds in the aggregate are $750 billion to $1 trillion short.
Whoa, that's a huge number. How did that happen?
Large relative to your household budget.
Yeah, that's significant.
Right. Well, in Jersey's case, it was abetted by the fact that New Jersey for 6 years found excuses not to put any money into the pension fund, and others have done some of the same. So some of it is underfunding by the employers. Some of it is, they talk about it as a perfect storm, but these perfect storms happen all the time, so you get to the point where you sort of accept perfect storms are part of life. But the perfect storm in pension land is when long-term interest rates get lower, which they have over time. That means that what you're going to have to pay out gets larger. And when stocks behave badly, as they basically have over the last 6 years, so you don't have much money in the till, and then you combine that with these actuarial fictions. I run an investment fund, but even if I didn't run an investment fund, if you have money somewhere with some manager and you call and you say, well, how much money do I have there today? The manager said, well, actually, your average over the last 5 years. You'd say, well, why do I want to know that? I mean, it's of irrelevance to me. But the way actuarial pension accounting works is when you say how many dollars are there, we take the average of the last 5 years. It happens for pretty much all these states that the average of the last 5 years is a materially higher number than the amount that's actually there today.
So you have a situation where when you referred to the corporate situation as being bad, it was really the corporate pension funds that we're reading about that are freezing their benefits to their current employees and cutting them. So what you're saying is it's significantly worse in the public employee sector across the country, the shortfalls.
However you want to do the math, the shortfalls are bigger in absolute terms. It's a worse problem on the public pension side, and over the next, we could get lucky. If we have a great bull market for a few years, that defers it, but probably over the next 5 to 7 years, it'll be a mammoth issue.
So what are you doing as the chairman of the Investment Council? What are you doing to try to mitigate this problem?
Well, I try to stay out of people's way, but no, it's sort of an easy call, or at least from my perspective, it's an easy call in Jersey, because historically we never had a nickel in private equity, real estate, hedge funds, which every large fund basically diversifies that way. All the academic theory says you're supposed to diversify. The endowments and the foundations, which have actually had the highest returns over the last 10, 20 years, and they have mammoth amount of diversification in alternative assets. Because New Jersey was at zero for the council, it's not just me, but for the majority of the council, it was a fairly easy call to say, private equity today, a lot of money going into private equity. I don't know what percent of assets really ought to be in private equity, but when I'm at zero, between say 0 and 6%, Yale is sitting there at 30% or whatever. Between 0 and 6%, nobody should be arguing with me. So since we're currently at 0 and moving to, say, 3 in each category, it's fairly easy to say, well, the most minimal thing you want to do is to achieve, even if we move as fast as we can, just because of the nature of the bureaucratic process, independent of the fact that we're being sued over doing this.
Oh, I didn't know that.
Yes, and that sort of slows things down. There's a lot of political resistance, but even if you took all that away, just the process of a state, when a fund is that big, getting the money out the door, it's hard to imagine that we could get to more than 13% in alternative assets over 5 years. I think when you get to 13%, 17%, people can have a legitimate intellectual argument about, well, what's the right number today? But from 0 to 3, it's
no big deal.
To me, it's not a hard call.
Well, it might not have been a hard call for you, but when the word was out that you were putting some money into hedge funds, the next thing I know, I pick up the New York Times, and there you are in a front page story that the state of New Jersey has decided to put some of its money into hedge funds, which have, I think, become a little bit of a boogeyman for Joe Public. And so I just wanted you to explain how it is that a public pension fund should be involved with a hedge fund. And by the way, you are a hedge fund manager,
That's
so
right.
just to complicate the picture.
That's right. No, and actually, there are a couple of things. First of all, if you look at the history of hedge funds, I mean, historically, the returns are very high. So if you just said the future will replicate the past, then you're supposed to do it. I don't assume that, but I'm just saying that's what the past looks like. But if you look at the diversity of what hedge funds do, one thing that's also true about the hedge funds as a group is they have much lower volatility than the stock market. And that I actually believe is something that will be true in the future. If you ask me to guess about the future, I'd say that the stock market doesn't do as well as people have been used to it doing. Hedge funds don't produce the returns that there's some statistical issues anyhow, but the returns that people perceive they got over the last 10 years are going to be harder with hedge funds going forward, but simply because they do so many different things and a number of them do hedge in some manner, the volatility will not be what you get in the stock market. So actually, the main reason that people are against it, which is that it's too risky, I mean, that to me is sort of mind-boggling, because if you take 20 randomly selected hedge funds just because they're doing different things, they'll have less volatility and less risk than the stock market. The tricky thing about hedge funds is that I think for the industry as a whole, I would be highly dubious that for the industry as a whole, managers will generate the kinds of returns that will justify those high fees. If that's true, then the tricky part is, how do I choose the right managers so that I'm not overpaying? I think overpaying is an issue, but the idea that I can own Intel and it can lose 90% of its value, and that to me is a perfectly safe idea, and I shouldn't be in hedge funds, it's just, you know, it ignores all the math.
We'll be right back.
The Zicklin School of Business at Baruch College of the City University of New York is the largest and most diverse accredited business school in the United States, offering high-quality, full-time and part-time degree programs at the undergraduate, master's, and PhD levels. For information about the Zicklin School of Business, please visit our website, zicklin.baruch.cuny.edu. That's zicklin.baruch.cuny.edu.
Welcome back. I'm speaking with Orin Kramer, Chairman of the New Jersey State Investment Council. How does one go about picking a hedge fund that won't bring great risk into a public pension fund like the New Jersey? How do you protect a public employee?
Well, the power of prayer is very, no, there are a couple of things. We have consultants, actually. One specializes in fund of funds, one specializes in hedge funds. And if, as they say, if a fund doesn't vet with them, meaning if they're not willing to recommend it, that's the end of the story. And then there's the investment division, which basically makes these choices full-time employees, not people who go back to my office afterwards and sit around with you, you know, in the afternoon. The division of investment employees make the individual manager selections. I would say a problem generally with states, I mean, we haven't been there enough for it to be our problem yet, but a problem generally with the states is that people who are trustees, at least we don't get paid, and I don't think most of them get paid, so they're doing it for nothing. They're not used to having their name in the newspaper in some negative context. A lot of them actually don't have any investment background, and so they're sort of skittish about what they're doing anyhow, because they're in there because they represent one of the unions. And when you put all those things together, there's a tremendous tendency to basically say, let's make investments that other states are making, that other people have made, that have been successful over the last 10 years. And that can, that's not necessarily the way people in the private sector look at investing, but the concern about reputational risk control, which is, in hedge fund land, there are or in private equity or real estate, they're the analogs to owning IBM and owning Intel, which is if I own IBM and I lose a bunch of money, I owned IBM. If I own one of these stocks that no one's ever heard of and I lose a bunch of money, then I'm an idiot. And the same dynamic. It's not just hedge funds. It exists for all these different asset classes, and it's probably a false kind of security to believe that because something has a good 10-year record or 20-year record, there's too much of a tendency to extrapolate and assume that that's predictive of what I'm going to be looking at in the next 10 years.
Well, the public pension...
I created a 10-year record when I was earning $47. Now I'm earning $17 million, and the truth is, what's the relevance of the record? Total conditions have changed, industry, competitive conditions, and people have some tendency not to look through that.
There has been a sort of pattern, though, of public pension funds that, as you say, they sort of all move in tandem, and it seems to me that we're seeing people moving in the direction of hedge funds, perhaps for legitimate reasons of diversification, but they're also seeking the higher returns that have been publicized with hedge funds in some cases. And I wonder what you think might happen if all of that money, when there's a significant amount of money in public pension funds, moves sort of simultaneously in herd-like fashion into the hedge fund land, as you call it.
Two things. First of all, in general in life, if whatever you're doing is the fad among a lot of other people, then you probably ought to look twice about what you're doing. Hedge funds, maybe there's a little bit of exception in the sense that if a lot of money pours into real estate's an asset class. If money pours into gold or money pours into any other asset class, it creates excess capacity and it can inflate prices. Hedge fund is actually just a legal description of an ownership form, and it's about a compensation system. And so when money goes into hedge funds, some of it goes into managers who go long and short in equities, but it comes out of long-only equity funds, or some of it goes into bonds. The point is, it isn't about an asset class. It's about basically a fee structure and a legal structure. But on the return issue, it's actually never come up, but internally, we actually don't assume that hedge funds will have higher returns than stocks. I don't know what numbers other people want to use. Our assumption is that they'll basically have returns in line with stocks, but A, there'll be less volatility, and B, it's not perfect correlation with stocks.
So you're getting the diversification.
Any time you add something to a portfolio that isn't there before, you tend to end up getting better risk-adjusted returns just by putting something different in it. I don't care whether the different is timber or oil or some hedge funds or private equity, precious metals. There's just an argument for diversification. Hedge funds, as I say, they're doing all the same things other people are doing. They're being paid differently. Are you paying somebody an appropriate amount given the risk-adjusted return they're going to generate for you?
So overall, do you think it's a plus then that public pension funds are moving into hedge funds? Or do you think it has some risks that concern you? I mean, as a public policy matter.
As a public policy matter. I think that hedge funds are appropriately a part of a portfolio. And I think probably you won't tend to have many of the large institutional funds showing up in places that are going to blow up. Certainly the Bayous of the world. I mean,
which is, just explain what that is.
I'm sorry. Bayou is, Bayou, however it's pronounced, is a hedge fund, which I guess was a total fraud, and they were fictionalizing the numbers. But I mean, one of the things at Bayou, if you said, well, who is the auditor? Because that's one of the first things people ask about a fund, and the auditor would have been a firm that nobody ever heard of. Actually, the auditor is a firm run by, I believe, the CFO of Bayou. That's the kind of thing that I think consultants do enough due diligence so that just doesn't happen, where the same guy sitting in the office doing the books at the hedge fund is, on Saturdays does the auditing of his own hedge fund. There were a bunch of warning signals there, but no, having said that, it isn't about public funds per se. More generally, I'm concerned that we live in a world in which there hasn't been a lot of visible risk. There isn't a lot of risk priced into the markets. Hedge funds, like others, are under a lot of pressure to generate returns. And in an environment where I haven't gotten paid for worrying about risk, and I've been rewarded for ignoring risk, people have a tendency to do that in order to survive, and I suspect there's probably a fair amount of leverage out there. And as a political matter, as you say, hedge funds are controversial. There'll be bayous, there'll be places to blow up, but at some point, I'd be concerned that there was a larger accident that had broader ramifications for people and that came out of somewhere in the hedge fund area. And then if people are going to feast on the fact that a bunch of people didn't pay attention to where they were invested and they lost whatever it was, a few $100 million in Bayou, then I think it'll be a much more serious political issue when there's something that creates ripple effects systemic in the financial system, which tends to happen in life, and hedge funds are these larger players, and somebody being part of, in effect, setting off a bomb is not an impossible scenario to imagine.
One of the things that I think complicates the hedge fund issue is the disclosure is more limited. And so if you're an employee of the state of New Jersey, for example, and you're trying to figure out, well, what are they investing my retirement benefits in? Can they find out?
Well, they can find out, in the case of Jersey, the name of the fund. But, it's an interesting question because there are these transparency issues. But it's always been interesting to me because let's not make it about hedge funds per se, whether it's hedge funds or, say, private equity. People say, well, I'll invest in private equity. I don't really know what those guys are doing. I mean, that's not going to be publicly released. I don't know what the hedge fund guy is doing. But you sit there in every public fund and you own banks, for example. They're blind pools of capital as far as you're concerned on the outside. They're levered at 16 to 1. That is to say they have $16 for each dollar of capital. And you don't know what they own. They do, by the way, invest in hedge funds, the large banks, and they invest in private equity, and they invest in real estate. The banks, the insurance companies. If you have like an Intel, I don't know how many companies Intel is incubating in their portfolio. I don't think there's anything wrong with it, but nobody gets freaked out over the fact that we actually never know what these individual investments are. There's just a small little line in the annual report that says this thing called other investments. Here's a bottom line number, and who they were and who blew up within that group or whatever. We never know about. We're not concerned about, which to me is okay. But then when we do it directly, I think it's more political sensitivity, because when we do it indirectly, then it never bothers us.
I've been fortunate to have the chairman of the New Jersey State Investment Council, Orin Kramer, as my guest. Thank you, Orin, for being on the show.
Thanks, Sarah.
We'll be right back.
Some people think of New York as the world's second home. The City University of New York, with students coming from 90 countries and speaking more than 155 languages, is the world's first university. Find us on the web at cuny.edu or call us at 1-800-CUNY-YES.
Whether we like it or not, public pension funds are going to be increasingly drawn to hedge funds as investment vehicles. They need to boost their returns if they are to have any chance of generating enough money to meet their obligations to state and local workers. In the hands of a savvy investment manager, this is not necessarily a bad thing. Orin Kramer, for instance, is himself a hedge fund manager. But many public pension funds are overseen by political appointees who are not necessarily steeped in the wily ways of Wall Street. Put unsophisticated investors with lots of money that isn't theirs in the same room with secretive hedge fund managers who are pursuing high-risk strategies in a loosely regulated environment, and you've got a recipe for disaster. There are already more than 8,000 hedge funds managing over $1 trillion in assets. What do you think the chances are that the SEC's overworked and underpaid staff is going to spot a problem before it develops? For USA Inc., I'm Sarah Bartlett.